And here is Eddie Ghabour. All right, welcome back, Eddie. Last time you were with us, you said that we were going to get a Christmas rally. It could be that we're seeing a Christmas rally right now. Maybe we're in it already. What do you think?
Absolutely. We said it was a coiled spring ready to explode back at the end of September, and we think this rally is going to continue to accelerate into the end of the fourth quarter because there's a lot of money on the sidelines that was on the wrong side of the trade predicting a 20% drop. And now they have to chase this market. So dips are going to be bought, in my opinion, going into the end of the fourth quarter. But that comes with a big caution sign. Investors need to take profits at the end of this year, in my opinion, because next year in the first half is going to look a lot different. So don't be greedy here. Take some profits at the end of this year and enjoy the epic rally that you had in 2021. It will be much different next year.
This is the first time I can remember when you said sell something.
Well, look, I think maybe one of the reasons why my Twitter handle is Common Sense Bull is I do try to take a common sense approach to this. And if you look at next year, we have 3 strikes against us. We have inflation that's going to be crippling to the consumer. It's almost mathematically impossible for them to have as much discretionary income next year as they did the first half of this year. So GDP is going to decelerate. Second is the Fed. The Fed has gotten the inflation wrong. It's not transitory. So now the Fed is going to be in a very tough position where they have to tighten while GDP is decelerating. Tightening while GDP is decelerating is one of the worst scenarios for the stock market. That's what's happening in Asia right now, and that's why their markets are taking a big hit. And third is earnings. When you do comps on earnings of first quarter next year and second quarter next year and try to compare it to peak earnings of first quarter and second quarter of 21, again, it's a tough stack. The deck is stacked against the market in the first half. I expect a 15 to 20% sell-off next year in the first half.
Okay, most of the people in our audience who've got any money in stocks have a lot of money in big tech. Are you now saying it's time to lighten up a little on some of the big tech gains that most of us have made?
So our playbook that we've shared with our clients is we're not taking it off the table yet because we do think that certain asset classes could go up another 7 to 12% before year end. By November and December, we're going to incrementally start taking risk off. And yes, big tech would be included in that. And then in January, we're going to be really playing defense by mid to late January next year because I would rather de-risk early than late so I can take advantage of the big drop that we think is going to happen.
Oh, so you'd get out now before the end of the year, but you're thinking of jumping back in again by mid-year of 2022. Is that your scenario?
That's it. If we get that 15 to 20% drop at that point in time, you'll probably have some great entry points and then hopefully enjoy a rally in the second half of next year. We haven't had a double-digit drop in quite a while, so we're due for one. And again, that data I just shared with you, I think is going to be very accurate and play out in the first half of next year.
You are very specific, Eddie. That's unusual in a man who manages money and goes on television. Most people are kind of vague about when it's going to happen and what's going to happen, but you've spelled it right out there. Lighten up in November and December, the big drop coming in the first half of next year, keep your powder dry and buy something by the middle of next year. Very interesting, Eddie. That's why you keep coming back. And we will see you again very soon, I'm sure. Thanks for being here today.
Thank you.
Got it.
Thank you.